Hey everyone, welcome back to Corporate Decoder, the place where we dig into the documents companies don't necessarily want you to read. Today, we're cracking open an N-CSR report, kind of like an annual report but filed with the SEC for Parnassus funds. Think of it as a peek under the hood of their various investment strategies, but don't worry, we'll keep it simple. This one's extra juicy because it's an amended version, meaning they had to go back and fix something. What could it be? Let's find out. This report isn't some thrilling page-turner, but it is key to understanding how Parnassus funds performed, what they invested in, and how they handled your money last year. So buckle up because we're about to become corporate decoders. We'll get past the fancy words, skip the boring parts, and focus on what this all means for you. First things first, let's address the amendment. It turns out they're updating the part about the financial statements. They had to make some corresponding changes to other sections, nothing too crazy, just a little house cleaning to make sure everything lines up with the corrected financials. This kind of thing happens sometimes, but it's a good reminder to always double-check the numbers. Now let's dive into one specific fund, the Parnassus Growth Equity Fund. This fund is all about finding US large-cap stocks that can benefit from big, lasting trends and are also at a good price. Basically, they're looking for quality companies in growing industries. So, how much did it cost you to have your money in this fund? For the investor shares, a hypothetical $10,000 investment would cost you $84 annually. That's about 0.84% of your investment. It's worth noting that the institutional shares, which are for bigger investors, have lower costs of 0.63%. But what about the returns? For the year, the investor shares returned about 26.85%, which is pretty good, but a little behind the Russell 1000 Growth Index benchmark, which hit 33.36%. Sometimes you win, sometimes you learn, right? The report attributes the performance being less than the index benchmark to stock selection in information technology, consumer discretionary and communication services sectors. But stock selection in the healthcare sector, along with a smaller investment than the index on consumer staples, actually helped the relative performance. Let's visualize this a bit. Imagine you invested $10,000 when the fund started in late 2022. By the end of last year, your investment would have grown to $18,310. The report makes it very clear that past performance doesn't guarantee future success, so keep that in mind. The fund has total net assets of about $63.7 million, which is not huge, but is nothing to sneeze at either. They held 42 different stocks, so not super diversified. The turnover rate, how often they buy and sell stocks, was almost 35%. They paid about $85,796 in advisory fees. Looking at the average annual total returns, over the last year, the investor shares grew by almost 27%. Since the fund started, it's up about 35% per year. The S&P 500 wasn't far behind, but the Russell 1000 Growth Index performed better than both. So what exactly did the fund put your money into? Almost half, 47%, was in information technology, which we already know didn't have the highest performance, but that is clearly this fund's focus. Other significant sectors were financials and healthcare. They only had small positions in real estate and consumer staples. The sector allocations give you a better idea of where the fund's betting. Specifically, the top holdings are Microsoft and NVIDIA and Alphabet. Amazon and Apple also account for a large percent. These big names make up a significant chunk of the fund. Good news here, there have been no disagreements with accountants. That's always a good sign. It means there aren't major disagreements about the financial picture. Switching gears, let's take a peek at the Parnassus Value Equity Fund. This one focuses on US large-cap stocks that are thought to be priced lower than what they are worth. The investor shares will run you about $93 or 0.88% on a $10,000 investment, so marginally more expensive than the growth fund. This fund returned about 12% for the year, lagging a little behind the Russell 1000 Value Index, which was up over 14%. Stock selection in healthcare notably drug relative performance, while strong stock selection in real estate boosted relative returns. If you invested $10,000 way back in 2014, you would have about $31,760 today. Of course, past performance is never a guarantee of future success. This is a much bigger fund with over $4.8 billion in assets, with over 40 holdings, so pretty similar to the previous fund we mentioned, a bit slower at almost 25%. They paid over $31 million in advisory fees, as expected for a fund of this size. Over the last year, the fund returned almost 12%. Over the past 5 and 10 years, it grew more than 12% per year, the Russell 1000 Value Index. Looking at how the portfolio is broken down, financials takes up a big slice, about 25.5%. The fund also has significant positions in healthcare and information technology. The top 10 holdings include S&P Global, Bank of America, and Cisco. These are well-established companies. Again, the accountants are in agreement with everything. Let's briefly look at the Parnassus Mid-Cap Fund. This fund focuses on mid-sized U.S. companies with long-term growth potential. It has a cost of $100, or 0.95% for the investor shares. It returned just under 10%, which is less than the Russell Mid-Cap Index, which returned over 15%. The fund has $2.8 billion in assets. The fund is primarily focused on industrials and technology. Top holdings include Fidelity National Information Services and TransUnion. Again, this has no material changes and no disagreements with the accountants. Alright, so what's my overall take on Parnassus funds after reading this report? It's clear that Parnassus has a disciplined approach, focusing on quality companies and sustainable practices. This focus on long-term value can be a good thing in a turbulent market. However, in the past year, that focus hasn't been as profitable as just following the indexes for the growth and the mid-cap funds. But it hasn't been bad either, so their approach has been more defensive, maybe. The value equity fund is huge with $4.8 billion. Its returns are underperforming but not terribly so, and its costs are comparatively low as well. What it all amounts to is a lower performing but low cost fund which is suitable for a particular kind of customer. The fact that they had to amend the report to update the financial statements raises a small flag for me, but overall, Parnassus seems to be a well-managed company with a clear focus and a commitment to environmental and social governance. The relatively low fees and the focus on long-term value are positives, but I would like to see the growth and mid-cap funds have performed better considering their smaller size. And there are significant capital loss carryforwards that should be addressed and understood. Overall, Parnassus seems to be a decent option if you're okay with underperforming benchmarks. Thanks for decoding with me. Be sure to like, comment, and subscribe for more corporate deep dives.